Hello and welcome. Welcome to our next NAP. NAP stands for Nonprofit Auditor Points, and I'm your nonprofit auditor. I designed these NAPs to help nonprofit communities to understand better some accounting and auditing issues and matters. These videos designed primarily for CFOs, accountants, financial directors, board members, and other folks within the organizations who have a need to understand system of internal control, accounting, and auditing matters. Okay, let's start. Today, I want to talk about the letter that usually issued by auditors at the end of the audit, and it's called recommendation letter or letter of deficiencies. And this letter typically issued at the end of the audit. I want to explain what that letter is, how that letter is supposed to be understood by the board members and management, and what to do with this letter, and what the terminology on this letter means. Okay, let's start. When the auditor performed regular financial audit, the goal of the auditor to issue an opinion on the financial statements, that they are not materially misstated. The auditor in a regular financial audit, we're not talking about single audit, we're talking about regular financial audit, auditor, it does not issue an opinion on the system of internal controls of the organization. How efficient it is, the system of internal control, effective, what works, what not works. We as auditors do not do that because our systems and the procedures are not designed to issue an opinion on effectiveness and efficiency of internal control. However, when we auditors perform financial audit, we learn about the organization internal control. We do understand what people involved in a cash disbursement, like payment in expenses or cash receipt, such as money when money come in from the grants or earned income, what individuals involved in a payroll process, who submits hours, how payroll gets paid, and other important areas of the organization operations. We do learn about the organization internal systems and controls. We also do perform some understanding through walkthroughs, meaning that we pull transactions and see how each transaction is recorded, who approves it, when it's recorded in the accounting system, how bank statement gets reconciled, and so forth. So therefore, auditors do understand majority of the internal procedures of the organization. And based on that understanding, the auditors design the testing of substantive testing to test the numbers. When auditors perform the testing and they find out some adjustments, and adjustments such as corrections, adjustments are very often indicators that some areas of internal controls are not working correctly. So because if you have good internal control, typically mistakes or errors will be caught on time and will be fixed. So to summarize, when the auditors perform the work, we do find through the adjustments and through our understanding of internal control, some areas that we see that not working properly. As a result of that, we as auditors issue the letter. And the letter called management recommendation letter or letter of deficiencies of internal control. There are some terminology that used in that letter that I know very often sounds very scary, and some management and board members do not like that terminology because it's very strong. So I wanna put you guys at ease and tell you that it's not because your auditor is mean, because it's required terminology that we're supposed to use. Auditors cannot invent the terminology, how we identify one findings from another finding. So in a letter, we as auditors, we're referring to deficiency or significant deficiency or material weakness. I know they all sounds pretty scary, but let me explain you what they mean. Deficiency occurs when the design in internal control of the organization does not allow management or employees to prevent, detect, and correct mistake on a timely manner. So, for example, bank reconciliations are not performed on timely, but they're not reviewed. It's one person who performs them and nobody looks at them. It could be deficiency, even though it does not result on any mistakes yet. But because nobody reviews it, it's a deficiency in internal control. It's the lowest level of deficiency. Then, if such a deficiency results in mistakes, it could raise to significant deficiency. And significant deficiency is more severe than just deficiency, but less severe than material weakness. But it's sufficient enough to bring it to attention to the governance and to management that the system of internal control is not designed properly and can potentially result in material weakness, that financial statement will be materially misstated. For example, one employee that submits hours also make changes to employees, personnel pay rate, and so forth. That could be significant deficiency. And finally, we as auditors, when we see that there are a lot of mistakes in one particular area of the organization, for example, grants record not correctly, and they result on material weakness, material mistake, that becomes material weakness. So it's significant deficiency that raises to the level of material weakness, or it could be a group of significant deficiencies that raise to becomes material weakness, and it causes financial statements to be materially misstated. For example, journal entries is just recorded by one person, accountant, and nobody looks at those entries. And as a result, they resulted in significant material errors at the end of the year when the auditors review financial statements. So there's 3 levels of deficiency. Regular deficiency, meaning there's some deficiency in internal control, does not make financial statements material misstated, or maybe not even result in errors, but there is a deficiency. Significant deficiency, typically it results in some error, mistakes, but they're not material. And material weakness, when there's really material mistakes on financial statements that make financial statements materially misstated. So those 3 types of deficiency. And very often, we as auditors will also point some other matters. They're not deficiency, but other matters to consider. For example, if the organization uses desktop version of QuickBooks, and we know that Intuit is no longer support desktop version, that could be other matter, where we would advise a non-profit organization to convert to online, QuickBooks Online, or consider some other accounting softwares. So what board needs to understand about this letter and management? This is auditor communication to the board and to the management. In my experience, I find that some board members and management are very happy to see those recommendations because they took it as the value-adding product and they can see what they can do better inside the organization, what they can change, what they can improve. Some board members and management take it as a very indication of their performance, and they sometimes disagree with the classification: deficiency, significant deficiency, or material weakness. In any regard, what I would advise to for nonprofits to look at that letter positively, because that letter is internal document that provide to the organization, and this is the opportunity for the organization to see where areas of internal controls can be improved, what the auditor is saying could be done better, because very often auditor comparing your nonprofit with other nonprofits organization and saying, hey, this is the better system exists, you might consider improving it. So I would advise take that letter with love and opportunity to improve the system of internal control. Very often in the small nonprofit organizations, we do see lack of segregation of duties. Very common area of internal control deficiency. However, even though we might even mention the deficiency, all nonprofit needs to do is say, hey, we're nonprofit organization, we don't have enough manpower to have a perfect segregation of duty, but we understand the risk and we make our board members to be more involved in reconciliation and review process. So what the board member and management need to do, take that letter, read it, and from the most important, address significant deficiencies and material weaknesses. Material weaknesses are the most important because that raises the risk of internal deficiency to the area where they become risky for the organization. They really put the financial statements in risk to be materially misstated. Board members should discuss with management and accounting and finance personnel why we have a deficiency, material weakness, a significant deficiencies. What can we do reasonable to make sure that those are not happening in the future, and see what little tweakle in internal control we can do. For example, deficiency would be lack of segregation of duty. Okay, we have a small nonprofit organization, we don't have enough manpower, we cannot segregate duties of custody, recording, reconciliation, and maybe review. So we will have a board member who will do periodic review, we understand it, but it's just deficiency. But if we have a significant deficiency, could be same person prepares and approve payments and nobody reviews it, that could be raised to the fraud risk. Therefore, if that significant deficiency is in your letter, board members need to step in and say, we need to segregate it. We need somebody else, not the same person who cuts the checks, approve the payments. Somebody else needs to approve. And material weakness would be, for example, financial statements contain large adjustments and they are not understood by management, by the board, person just recorded them. That's a really material weakness. Therefore, nonprofit can design the process saying no simple adjust your journal entries is recorded unless they discuss with upper management, and list of all the adjustments is provided to the board at the end of each quarter, for example, when we record large adjustment. So the response to the letter is critical, but again, this is internal letter. What it means? It means that the nonprofit does not need to provide it to external users, saying that some donors do request the letter of internal letter, to provide the internal letter. Some nonprofits who go through merger acquisition also require to provide that letter. But again, as soon as the organization understands the letter, responds to the letter, I do believe a lot of external users will absolutely be fine with the letter. Again, it's a great value-adding product. So let me point a couple of things that I encounter in my career where the board members and management do not have a proper understanding auditor roles in the organization's internal system of internal controls. For example, new accounting pronouncement. Lately, we had new lease agreement, new lease standard 842, and some nonprofits expected the auditor to do implementation of that new standard. Auditor is independent. An auditor cannot be responsible for implementation of the new standard. Now, management and board can ask for the guidance of the auditor, can ask for referring to some educational material or some asking overall questions. But if the organization does not have a system of internal control that allows the organization to understand what new standards are required, did not perform any implementation, it could be significant deficiency or even material weakness if the new lease amounts that resulted due to implementation are material. So the nonprofit cannot say that we rely on auditor, because auditor is not part of the organization internal control. Again, auditor can be advisor, can be consultant helping, but cannot be responsible for implementation. Another very common mistakes that we see, that nonprofits would say we relied on auditor to maintain our fixed asset schedule. Therefore, it would not be deficiency, and that's incorrect. Again, auditor can help you to consult, advise with your guidance with the organization review. However, auditor cannot be responsible for maintaining fixed asset schedule because auditor is independent. Auditor does not know about all the additions to fixed assets, all the maintenance of the fixed assets, all disposals of the fixed assets, and record depreciation is the job of the organization. Therefore, that can be deficiency, significant deficiency, or even material weakness if the depreciation amount is material. And the last is the most important, very common recommendation that we issue if we see that the organization has significant amount of cash deposits that above FDIC insured amount. Federal insurance covers $250,000 per entity per bank. Therefore, if nonprofit does not need immediate liquid need to have significant amount cash on hands, that could be indication of risk, significant deficiency. So, to summarize, as an auditor, I would advise you to love letter of significant deficiencies, material weakness, and other matters. Treat it with the opportunity to improve your system of internal controls. Communicate with your auditor why they classified some findings deficiency, significant deficiency, material weakness, and use it as the opportunity to improve the system of internal control of the organization. Thank you so much. Pleasure to be here with you, and looking forward to see you for our next snap. Thank you, and have a wonderful, productive day. Talk to you soon. Bye-bye.